$90,000 RVs are being dumped for $16,000. Clean rigs, low miles, no recalls, just prices slashed overnight by sellers who ran out of time. When assets fall this fast, something underneath the market has already broken. Here's what most people don't see. Once one RV sells that low, the entire market resets downward. Lenders tighten, dealers blink, and owners rush for the exits. What looks like opportunity is actually pressure spreading fast. Before you buy or sell, you need to understand what's driving this crash and why it's accelerating. $16,000. Listings. Listings tell the story faster than headlines. RVs that sold for $90,000 2 summers ago are now posted at $16,000, sometimes less, with handwritten tags begging for calls. Screenshots from RV Trader show late model travel trailers marked reduced twice in 1 week. Dealer photos from Indiana and Arizona show identical floor plans stacked together, each wearing a lower number than the last. These are not damaged hulks. Many show low mileage, clean interiors, and recent service notes. The shock is not condition, it is velocity. What makes this dangerous is how fast pricing signals have broken. Once a $90,000 RV clears at 16, every similar unit instantly loses credibility at higher numbers. Buyers stop negotiating upward. Sellers start racing downward. The lowest sale becomes the reference point, not the best condition. That shift rewrites value across the board in days, not months. Here is the line everyone misses. Prices did not slide down. They were shoved. Cuts arrived overnight, uneven and panicked, the kind that follow a deadline. Something outside the listing sites forced sellers to act now, not later. That force explains why the same rigs keep reappearing cheaper, and why the next chapter starts. 4 million units, nowhere to go. Those rigs did not vanish, they stacked. Roughly 4 million used RVs hit resale channels since early October, according to aggregated counts from major listing platforms. You can see it from the air. Drone footage over dealer overflow yards shows rows packed nose to tail, blocking movement. Satellite images reveal fields turned storage, guarded and lit at night. Space became the constraint, not demand. When inventory overwhelms space, time becomes the enemy. Units sitting idle still accrue costs, still age, still decay. Sellers lose the ability to wait for the right buyer because the clock is louder than hope. In that environment, price is no longer a strategy. It becomes an escape route. But here is the uncomfortable truth. Oversupply explains falling prices, not panic. Markets tolerate excess for months. What forces $16,000 prints is timing pressure. Someone needed units gone before a date certain. That pressure does not come from shoppers. It comes from balance sheets. Follow the path. Full lots choke new deliveries. Orders pause. Payments remain. The pile grows heavier each day. And the reason sellers blink first is revealed by the decision that built this mountain in the first place. If this breakdown is helping you see what's really happening, hit like so it reaches others. Subscribe for updates as prices keep moving, and share what you're seeing in your area. These shifts are fast, and real-world signals matter right now. The pandemic build decision. That decision was made during the boom. Factories built, as if demand would never cool. Shipment records show output peaking through 2021 and 2022, even as cancellations crept in. Plants added shifts, locked suppliers, and pushed volume. The assumption was simple. Cheap credit would carry everything. Those factory decisions are not history. They are sitting on lots today. Every extra unit built during that surge added another obligation that never disappeared. When demand cooled, the debt stayed. What looked like confidence then now acts like a weight pulling prices lower with no relief valve. Here is the key link to $16,000 listings. Overbuilding creates vulnerability, not collapse. The collapse arrives when financing terms change. The moment debt costs rose, the math flipped. Units that penciled at low rates became cash drains overnight. This is why prices fell unevenly. Some sellers could wait, others could not. The ones exposed to higher carrying costs moved first, slashing to stop the bleed. That behavior rippled outward, resetting expectations for everyone else. The next force finished the job by doubling payments without warning. The shift erased breathing room, accelerated breakdowns, and transferred control out of owners' hands nationwide before most realized what was happening. The rate reset. Payment shock closed the trap. Loans written near 3% hid true cost. Examples from credit unions show a 40-foot travel R-Vee financed in 2021 near $600 monthly. Reprice the same balance above 8%, and payments jump past $1,000. That change arrives regardless of use. The math changed without asking permission. Monthly obligations jumped while resale values dropped, squeezing both sides at once. That combination removes flexibility fast. Once payments outpace patience, decisions stop being emotional and start being enforced. And enforced decisions always move quicker than planned ones. Here is the moment control changes hands. Miss one payment and timelines compress. Notices trigger recovery orders. Options disappear. Banks sell to recover, not to maximize value. Each forced sale prints a lower comp that spreads fast. This explains the cliff. $16,000 listings are not generosity. They are exits. When payments double, patience ends. The market does not wait for emotion. It enforces math. And once math takes over, prices move faster than explanations. Deadlines stack. Lenders act, and the next phase begins before sellers realize leverage already vanished everywhere across markets nationwide. Right now, today, with no appeals left remaining available. Repossession, pipeline. Repossession does not start with a tow truck. It starts quietly, a missed payment, a notice sent electronically, a phone call that goes unanswered. Data from regional recovery agencies in the Midwest shows R-Vee recovery orders rising sharply since midsummer, with some counties reporting volumes nearly double compared to the same period last year. Insurance holding yards outside cities like Fort Wayne and Des Moines are filling with surrendered travel trailers and motorized units stacked tightly behind locked gates. These units do not sit long. Once logged, they are moved quickly to reduce exposure. Each repossession acts like a forced signal to the market. It is proof that someone lost the ability to hold. Banks price for recovery, not pride, and those numbers leak into public expectations immediately. One low recovery does more damage to pricing than 10 optimistic listings ever could. Here is the transition that matters. Repos do not end the story. They feed it. Every recovered unit moves downstream into the place where prices stop being negotiable and start being final. Auctions set the real price. Wholesale auctions are where the market admits the truth. Platforms like IAA and regional dealer auctions publish hammer prices that cannot be argued with. A Class C motorized R-Vee that sold for $80,000 in 2022 now struggles to clear $45,000, even with low mileage. Fifth wheels, once trading near $60,000, are hammering in the low 30s. These are not asking prices. They are completed sales, documented and time-stamped. Wholesale sales remove storytelling from the equation. When a unit hammers at 45, no explanation can lift it back to 80. Those results quietly flow into lending models, appraisals, and trade offers. By the time retail adjusts, the damage is already locked in. This is the gravity dealers cannot escape. Once auction floors reset lower, every unit on a lot becomes overvalued overnight. The pressure then shifts inward to the cost of holding inventory itself, floor plan pressure. Most dealer lots are financed, not owned. Floor plan lending allows dealers to stock R-Vees while paying interest daily until each unit sells. As rates climbed, that daily cost doubled. Aging rules make it worse. Once a unit sits beyond 90 days, lenders apply penalties or demand curtailment payments. Dealer bulletins confirm that aged inventory now triggers immediate balance reductions. Every day a unit sits, it burns cash invisibly. Interest compounds, penalties trigger, and balance sheets tighten. At that point, holding out for a better price costs more than taking a loss. That reality turns patience into liability for dealers long before the public notices. Here is where behavior changes. When losses pile up, transparency disappears. Dealers shift tactics from price cuts to paperwork adjustments. The loss does not vanish. It gets relocated, usually to the finance desk, the finance office cover. Advertised discounts rarely survive the contract table. Sample finance sheets leaked from Midwest dealerships show price reductions erased by add-ons, extended warranties, paint protection, documentation fees renamed as market adjustments. An $8,000 markdown disappears under $9,000 in extras. Monthly payments look manageable because loan terms stretch longer, not because the deal improved. When margins vanish on the lot, They reappear on paper. Longer terms, stacked add-ons, renamed fees. The sticker suggests relief, while the obligation grows quietly underneath. The danger is not the discount itself, but believing it represents savings when it merely relocates the loss. Paper adjustments hide losses temporarily. Fees replace margins. Longer terms mask higher totals. Buyers see reduced prices but commit to larger obligations. The deal looks safer than it is because risk has been relocated into future payments instead of removed altogether. Here is the final pressure point. Lots are full. Storage is maxed. Cash flow is thin. When physical space runs out, pricing games stop working. The next phase is not negotiation. It is liquidation. And that shift is already starting to surface across dealer yards nationwide. Storage is the silent cost. Storage is where value quietly dies. Once a RV stops moving, decay starts working against it every day. Storage operators across Indiana, Arizona, and Texas have raised monthly fees sharply, citing insurance hikes, overcrowding, and liability exposure. Satellite images show lots packed bumper to bumper, units sitting so close that inspections require moving multiple rigs first. Batteries drain, tires flat spot, seals dry out, rodents move in. None of this shows up on a listing photo, but all of it shows up later on a repair bill. Value erosion does not require mileage. Sitting still is enough. Fees accumulate, components age, small problems grow unseen. By the time a unit moves again, its condition no longer matches its appearance, and the gap between expectation and reality widens quietly. Time degrades assets even without use. Storage introduces decay, cost, and risk simultaneously. What sits still does not stay equal. As months pass, value erodes invisibly, ensuring that delayed sales rarely recover what patience was supposed to protect initially. This is the echo effect. Overflow does not stay contained. When storage fills, factories feel it next, because unsold inventory stops new orders cold. That pressure migrates outward, tightening supply chains, freezing schedules, and signaling that the damage spreading through storage yards has not finished reshaping prices yet. Across regional markets, nationwide now, factories go quiet. When orders stop, factories go quiet. Fast. Production lines are built for momentum, not pauses. Warn notices filed in northern Indiana and surrounding regions show cutbacks at multiple R-V plants, with shifts reduced or eliminated entirely. Parking lots, once full during overnight runs, now sit half empty. Local diners close early. Suppliers idle trucks. This is not seasonal slowdown. It is demand collapse, working backward through the system. Production slowdowns confirm the imbalance. Manufacturers do not pull back unless orders vanish. When lines stop, confidence drains out of the system, and resale expectations adjust downward to match the new reality. That signal reaches markets long before official statements ever do. Manufacturing slowdowns confirm imbalance. Plants only idle when demand disappears. Those signals travel fast through markets, lowering confidence and expectations. When production stops, resale optimism weakens because fewer buyers believe recovery is imminent enough to justify holding prices firm. This damage does not stay at the plant gate. When income disappears, travel plans shrink. The lifestyle math that once justified ownership starts to crack, and the cost side begins rising at the worst possible moment. Fuel prices, campground fees, and insurance bills do not pause with production. They continue climbing, turning reduced income into immediate pressure on households already stretched thin. This imbalance accelerates exits and forced sales before confidence can recover locally. Subscribe now if you want clear, no-pressure updates as this market keeps resetting. We're tracking real pricing, forced sales, and timing shifts so you can stay ahead. Protect your money and avoid decisions that look cheap today but cost later. Campgrounds. Flip the cost. Campgrounds have flipped the cost equation. Nightly rates that once hovered near $30 now push $60 or more, according to posted pricing from national chains and regional operators. Corporate consolidation is the driver. Groups acquiring independent parks standardize fees upward while trimming maintenance. Hookups fail more often. Restrooms close earlier. The bill still rises. For owners trying to wait out resale losses, the road no longer offers relief. Operating expenses now punish waiting. Site fees, fuel, and insurance climb while resale values fall. What once offset ownership now accelerates exit decisions. When staying put costs more than selling, patience collapses and inventory returns to market faster than expected. Rising operating costs collapse waiting strategies. Site fees, fuel, and insurance erode budgets, while resale values fall. Ownership stops offsetting expenses and starts compounding them. That shift pushes hesitant sellers into action sooner than planned, swelling supply further. This cost squeeze feeds back into the market. When travel stops saving money, units return to listings faster. That adds to congestion, but not evenly. Some categories choke first, others follow later, and that imbalance reshapes pricing in unexpected ways. Motorized rigs feel it before towables because fuel exposure magnifies losses. High operating costs accelerate sell decisions, pushing those units into already crowded channels. This uneven pressure sets up the next breakdown by category across the country as inventories stack deeper. Breaking down the 4 million. The 4 million listings are not equal. Roughly half are travel trailers built during the pandemic surge. About 1/4 are fifth wheels parked after diesel costs spiked. The remainder are motorized R-Vees, heavily weighted toward repossessions returned to lenders. This mix matters because each category collapses at a different speed. Travel trailers flood first. Motorized units fall harder when they fall. Not all units fall the same way. Volume crushes some categories, while complexity cripples others. Understanding which rigs flood first explains why certain prices collapse faster. Blind buying ignores that difference and absorbs risks meant for someone else. Category matters because risk concentrates unevenly. High-volume units drown in numbers. Complex units drown in cost. Ignoring composition leads to mispriced expectations. Understanding which rigs flood first explains why some listings implode, while others resist longer before eventually following. This is where cheap listings turn dangerous. A low number can hide deferred maintenance, water intrusion, or electrical neglect from months of sitting idle. The market looks full of opportunity, but many of those opportunities carry costs that only surface later, long after the deal feels done. That risk skews highest in units with complex systems and high replacement parts costs, which amplify mistakes made during rushed purchases. Understanding this mix becomes essential before acting on any apparent bargain you see today, because composition dictates losses ahead. Next, the bargain mirage. Cheap listings look clean for a reason. Auction inspectors document it repeatedly. Fresh decals hide warped siding. New vinyl flooring covers soft subfloor. Bleached cushions mask moisture damage. Units pulled from flood zones or long storage often receive cosmetic work before relisting. Auction condition reports from Louisiana and Texas show water intrusion flagged in more than 1/3 of late-model motorized R-Vees sold this year. Those notes never appear in resale ads. Photos show shine, not structure. Surface-level fixes delay consequences, not costs. Cosmetic repairs create confidence without restoring integrity. Buyers who trust appearance inherit problems deferred by previous owners, turning apparent savings into future bills that arrive without warning. Visual condition misleads when systems fail underneath. Cosmetic improvements delay discovery, not damage. Buyers inherit problems disguised as value. What looks like savings often represents deferred expense, scheduled to surface after ownership transfers, and protections expire quietly. This is the pivot. Price alone cannot filter risk anymore. Listings lie by omission, not description. The only defense is physical verification, because inspection determines whether a low price is protection or punishment. That filter decides who survives the crash and who pays for it later. Inspect or lose. Mechanical failure is where savings disappear. Repair invoices show the pattern clearly. Roof resealing runs several $1,000s. Slide motor replacement costs more than many discounts offered today. Inverter failure alone can erase weeks of negotiation. Inspection reports from independent technicians show battery banks failing after long storage, propane lines cracking, and generators seizing from inactivity. None of this improves with mileage reduction. Mechanical reality overrides pricing optimism. Systems either work or they do not. When they fail, repairs ignore purchase discounts and demand full payment. Skipping verification shifts risk forward in time, where it becomes far more expensive. Mechanical failures ignore purchase price. Repairs demand full payment regardless of discounts. Deferred maintenance compounds quickly, After inactivity, inspection determines whether risk is avoided or absorbed. Skipping verification trades short-term confidence for long-term expense that arrives without negotiation. Here is the transition that matters. Even after inspection, ownership depends on financing. Mechanical clarity does not override bank rules, and those rules are tightening fast, cutting off exits many expected to rely on next. Credit freeze. Credit conditions have hardened quietly. Lenders now restrict R-Vee loans by age, value, and balance. Units older than 5 years or priced below certain thresholds often qualify for nothing. Insurance premiums climbed alongside replacement part costs, raising deductibles and lowering coverage. Policy notices confirm increased rates, even for parked units. Refinancing doors closed just as payments rose. Financing constraints remove exits. Without refinancing or affordable loans, owners absorb pressure longer than planned. Negative equity becomes permanent, not temporary, trapping decisions inside shrinking options that favor institutions, not individuals. Tight credit removes escape routes. Refinancing disappears, insurance costs rise, negative equity hardens. Without lending flexibility, decisions become fixed. Pressure accumulates until owners act under disadvantage, while those with liquidity gain leverage by simply waiting. This is where patience flips from weakness to strength. When credit freezes, cash and time gain leverage. Waiting stops being passive. It becomes strategic because pressure keeps building elsewhere while options narrow for sellers. Deadlines stack. Interest accrues. Storage fills. Banks enforce rules. Those who can wait let math do the work, watching prices fall without chasing listings, avoiding regret, and stepping in only when sellers have no room left to maneuver at all during this collapsing market cycle now. Timing beats panic. Markets move on calendars, not emotion. Historical pricing charts show R-Vee values bottoming between late winter and early spring after inventory ages through year-end audits. Dealers facing renewed floor plan reviews slash prices again to clear books. Seasonal demand pauses during holidays, pushing leverage toward those who wait. Prior downturns show another drop often arrives 3 to 6 weeks after the first major cut. Markets reward those who let deadlines do the work. Inventory ages, audits approach, and pressure compounds quietly. Waiting is not inactivity, it is positioning, allowing leverage to increase without cost while others exhaust theirs. Timing rewards restraint. Inventory ages, audits approach. Sellers face deadlines, buyers do not. Waiting allows leverage to build without cost, shifting advantage quietly. The market resolves itself through calendars, not courage, and patience determines who captures the spread. This is the final truth. The crash is not finished. The next markdown wave is already forming, driven by storage limits, credit freezes, and calendar pressure. Acting early feels decisive, but waiting often proves smarter. The difference shows up in your balance long after the noise fades, when rushed buyers regret timing and patient watchers quietly save thousands by letting deadlines force sellers to blink first. That patience is leverage most people never realize they still have today right now. This crash isn't loud, it's quiet, methodical, and unforgiving. Prices are resetting because credit snapped, inventory piled up, and time turned expensive. The smartest move now isn't excitement, speed, or hope, it's patience, verification, and discipline. Watch the transactions, not the asking prices. Let pressure do the negotiating for you. Windows like this don't announce themselves, and they don't last long. When stability finally returns, the bargains disappear first. This market is moving fast, and the smartest advantage right now is staying informed, not rushed. If you're seeing price cuts, repos, or dealer pressure in your area, drop a comment. Real signals matter more than headlines. Hit like if this helped you see what's really happening, and subscribe so you don't miss what comes next. We're tracking real prices, forced sales, and timing shifts, so you can move smart, not emotional.